Hier ist die neue Folge der Ökonomie-Videos.
All right, so when you think about making money in the market, what's the first thing that comes to mind? For pretty much everyone, it's that classic rule: buy low, sell high, right? It's like investing 101. But what if you could totally flip that script? What if you could actually make money when prices are going down? I know it sounds completely backward, but stick with me here. This is a huge part of how modern markets actually work. So let's dive in. Let's look at how investors find that silver lining, the upside of down. Okay, so the most direct way to do this, it's something called a short sale. Think of it as the complete opposite of a normal investment. Here's how it works in a nutshell. First, you borrow some shares that you think are way overvalued. Then you immediately sell them at that current high price. Step 2. You wait. You let the price drop just like you predicted. Then you buy back the exact same number of shares, but at that new, lower price. Finally, you return the shares you borrowed to the lender, and that price difference, that's your profit. It's a neat trick for sure, but there's an even more powerful tool out there. And that tool, my friends, is the financial option. Which brings us to our main topic: options. You can think of them as a really sophisticated bet on which way a price is going to go. Now, if you want to bet that a price is going to drop, the specific tool you'd use is called a put option. And listen closely, because this next part is absolutely critical. A put option gives you the right, but not the obligation to sell something at a fixed price. You're buying the choice to sell, but you're not locked into it if things don't go your way. And that's the huge difference between an option and, say, a future. With an option, you can make the trade. With a future, you must. That choice, that flexibility, is what makes options such a game changer. All right, theory's great, but let's walk through an example to really see how this works. Let's imagine there's a stock, and right now it's trading at 50 euros. You've got a hunch, you've done your homework, and you're pretty sure that price is about to fall. So you decide to buy one put option. This little contract costs you just €1. And for that single euro, you've locked in the right to sell that stock for 50 euros anytime in the next month. That's it. That's your entire investment. And what do you know? A couple of weeks go by and bam, you were right. The stock price tumbles down to 47 euros. So what happens now? What does that mean for that €1 bet you made? This is where you cash in. You exercise your option, which means you use your right to sell the stock at that guaranteed price of 50 euros. Now, you don't actually own the stock, so your broker does this all in a flash. They buy it on the open market for 47 euros and immediately sell it for 50 euros using your option. That creates an instant €3 profit. Then, of course, we have to subtract the euro you spent to buy the option in the first place. And that leaves you with €2 in your pocket. Not bad, right? You put in €1, you got €2 back in profit. But let's really think about that. You risked one single euro, and you made €2 of pure profit. So what is that as a percentage return on your investment? 200%. Let that sink in for a second. The stock price only dropped by about 6%, but your investment, it grew by 200%. This incredible power, this magnifying glass for your money, has a name: leverage. It's what lets you control a big asset, like a 50 euro stock, with just a tiny amount of cash. It's what makes these massive gains possible, but, as we're about to see, it's a double-edged sword. So that put option we just talked about, it's just one tool in the toolbox. There are actually 4 basic plays you can make, depending on which way you think the market is headed. So let's map it all out. As we just saw, if you buy a put, you're betting that prices are going to fall. But you can also sell a put, which is the opposite bet. You think prices will rise. On the other side of the coin, you have call options. Buying a call gives you the right to buy a stock, so that's a bet on rising prices. And you guessed it, selling a call is a bet that prices are going to fall. See, it's a complete system for any scenario. Okay, before we all get too excited about those 200% returns, we have to talk about the other side of leverage: risk. And the source material for this explainer says it best. The invested capital can multiply very quickly, but can also be completely lost. So let's rewind our example. What if you were wrong? What if, instead of falling, the stock price had actually gone up to, say, 51 euros? Well, your right to sell at 50 euros would be totally useless, right? Why would you sell for 50 when the market price is 51? You wouldn't. Your option would just expire and be completely worthless.
And this highlights something incredibly important about buying options. Your maximum loss, the absolute most you can possibly lose, is capped at what you paid for it. In our case, that was just €1. Your potential gain is huge, but your potential loss? It's fixed and known from the very start.
So there you have it. You now know the basic tools investors use to play both sides of the market, profiting not just when things go up, but also when they go down. They're powerful, they offer some serious leverage, but they are absolutely not without risk. So it all boils down to one final big question. Now that you know the tools, which way would you bet?